Hi, everyone. This is Robert with Gold Silver Pros, and today I have Michael Pento, the founder of Pento Portfolio Strategies, with me. His firm maintains two separate portfolios and uses a proprietary set of metrics to determine market direction and strength to profit from macroeconomic shifts in the world economy. Mr. Pento is a well-established specialist in the Austrian School of Economics and has been a regular guest on shows such as CNBC, Bloomberg, Fox Business News, and CNN. He's also the author of The Coming Bond Market Collapse, and his market analysis can also be read in most major financial publications, including the Wall Street Journal. He also hosts a weekly podcast called The Midweek Reality Check, available through subscription on his website. How are you doing today, Michael?
I'm very well, and thank you for having me on the program, Robert.
Thank you for joining the program. I've been reading your stuff and watching your videos for quite a long time, and I appreciate your insights into the economy. I also followed the Austrian School of Economics, and that's what led me to establishing my own website, Gold Silver Pros, and also writing for the last 10 years. So I think we have a lot in common. And I wanted to ask you, based on some of the recent interviews you've done, you indicated, for example, on Robert Kiyosaki's radio show earlier this year, that 19 of your 20 economic indicators that you use to model your portfolio are flashing red. Can you talk a little bit about why those are flashing red, and if you think we're heading into a recession or where we are in the economic cycle?
Okay, good. So good question. So you're talking about what happened in the fall of 2018. So I run my model on a daily basis. So that changes on a daily basis during some time. So the model right now is not flashing bright red. It's probably flashing, I guess, bright amber. So, but at the time when I said that, it was 19 out of the 20 components. So I have 10 components for inflation, 10 components for the economic cycle. Right. And virtually every single one of them was telling me that we were heading into a deflationary recession/depression in the fall. And that's exactly what happened. It did not pick up exactly when to switch from a more moderate cycle. So I have 5 sectors in my inflation deflation spectrum in which I invest, sectors 1, 2, 3, 4, and 5. One being a deflationary depression, one being a stagflationary intractable inflation cycle. So this cycle moved into sector 2 and sector 3 in late January. That's when I closed out most of my shorts. And we've been vacillating between sectors 2 and 3 ever since. So we're still on that dangerous kind of heading towards disinflation, deflation, but definitely slower growth is prevalent right now.
Okay. So what's your outlook for 2019? How many of your indicators are telling you that we may be headed toward recession? Do you still think that we are, or do you think that there's been a decent recovery?
I think that 2020 could be very challenging. And we've had some very trenchant events happen in the last few days. We had the escalation of the trade war, which I think is a very big deal as far as one of the major central bank monetary policies, and then you also have government, household, and corporate debt as a percentage of GDP. You have in my model, I'm reading my model off to you now, some of my components. We have real interest rates, effective Fed funds, 10-year break-even spread, and we have government, household. I read that to you already. Sorry. Equity valuations and growth rate of earnings. So all of these components are constantly changing. But lately, if you see that you have the trade war escalation, and you also have a declaration of as China as a currency manipulator, these things will affect the model's output, and they have affected the things that I just mentioned.
Okay. The recent decision by the Fed to cut by a quarter point and also stop its quantitative tightening program on the treasuries that it was rolling off of its balance sheet. What do you think that that's going to do for the economy for the rest of 2019?
Well, you have to understand that quantitative tightening was a massive destruction in base money supply. So $600 billion of base money supply was destroyed through the Fed's quantitative tightening program. And remember, they told us that it was going to operate in the background and it's going to be like watching paint dry. Nothing could be further from the truth. I don't know if the Fed really believed that, or if they were really doing their darndest to try to convince you that that would be the case. But you cannot destroy the base money which is what banks use to make money through the fractional reserve system to expand the money supply in the broader aggregates. You cannot destroy that and not affect the dynamic of disinflation and inflation.
Okay. Do you think the Fed's ever going to be able to tighten again? What I've written recently is I think that they're on the path that they're going to have to ease forever. This is going to be QE forever and rate cuts forever. And eventually, I think that they're going to have to go to negative interest rates, much like some of the rest of the world is doing with its debt and also with its banking system. Do you see that in the cards? Or maybe do you think that they're going to have the opportunity to tighten again?
Well, you know, Jerome Powell had to acquiesce into lower interest rates, as we mentioned, in his July 31st meeting. He gave the reason that there's this trade conflagration with China. But in reality, I mean, there's many other more intelligent, cogent reasons why he had to cut interest rates. He's cutting interest rates perhaps to weaken the dollar. He's cutting interest rates to revert the yield curve. That would be another good reason. He needs to try to keep asset bubbles levitated. That's the real, the most salient reason why he's cutting interest rates. But you have to ask yourself the question: if the ECB is at zero and still in the middle of QE, if Japan is still in the middle of QE and has never gotten off zero and probably never will, how far off 0% interest rates can the U.S. maintain its monetary policy? So we're at 2.25 right now. Like you, I believe we're headed back towards the zero bound range, just for the reason why they have to revert the yield curve, weaken the dollar, and they have to try to do everything they can to keep markets in a bubble, and that's what they're going to end up doing. And the pressure from overseas to continue to do so. Right.
I think the rest of the world has something like 13 trillion in negative interest rate bonds so far. So it seems like the direction has been there.
More than that. I think it's more than that now. I think it's closer to 15 trillion now. You have the entire German interest rate complex from, overnight bank lending to the 30-year German Bund now in negative territory. So I think it's closer to world record 15 trillion. I mean, you would think $1 of negative yielding sovereign debt would be a bit troubling. But we have 15 trillion. You also have negative yielding sovereign debt. You also have junk bonds. There's, I think, 14 companies in Europe that have negative yielding debt, and they're rated junk. And you have 100-year sovereign bonds that are trading below 1%. So it is a very interesting time that we're in, and it's like nothing we've ever seen before. And I'll say to you, I don't think, Robert, that central banks have really given much thought of ever creating an exit strategy, a cogent and viable exit strategy. Because I mean, one day they're going to be successful in creating inflation. I mean, they've already created massive inflation in asset prices. You know that. The way they measure inflation, if you look at core CPI, where it's up 2.1% year over year, so they have created consumer inflation. But one day they're going to ascend to the fact that they've achieved success in creating consumer core, they call it a core PCE deflator, above 2%. And then, of course, that's the way they measure it. So real inflation is going to be much higher. So at that point in time, when you have negative yielding junk bonds and central banks around the world concurrently have to reverse course, I mean, remove their bids from the stock market and the bond market. I mean, I don't think yields are just going to gradually, innocuously ease up from where they are. I mean, that to me is not a possibility. You'll see a German junk bond go from negative, a few basis points to where they should be, 4, 5, 6% at a minimum, very rapidly. You imagine, because if you hold a junk bond, Robert, why do you hold that bond? You're not holding it for the yield. And, the only reason why you're holding it is because you think that yield is going to be more negative. So your principal is going to be going higher. You certainly can't hold it to maturity if the company that you're holding it, if the underwriting company is going to be still around. So there's going to be a panic out of junk bonds. And when you panic out of junk bonds, you're like we had in the fall of 2018, the junk bond issuance market dries up completely. And then what are you left with? You're left with massive layoffs, zombie companies going bankrupt, junk bond companies going bankrupt. This is going to be this is going to be something that we've never before seen before on a global basis. If you thought that the mortgage crisis, which is about $1.5 trillion of mortgage debt that was at most risk, that blew up in 2008 when $5.4 trillion worth of triple B junk bonds and CLOs go bankrupt. You're going to see a crisis like we've never seen before.
Mm-hmm. So you're talking about maybe a worldwide global deflationary depression, or at least a recession, is in the books.
I'm going to sound like a Cassandra and hyperbolic here, but I don't think you can have a worldwide recession any longer. I think the extent of the leverage, especially in the corporate bond market globally, it has risen to such an extent that a mild average recession is almost impossible, especially in light of the fact that the ECB and the Bank of Japan have no room left on the monetary policy front to lower interest rates. I mean, do we really think that Deutsche Bank, they have a negative deposit rate? Their assets that are parked at the ECB have a negative depot rate of minus 40 basis points. Does anybody believe that a minus 50 basis point interest on their excess reserves is going to be a panacea? So there's no room left to lower interest rates in most of the developed world. And the United States only has now 8 bullets left in the chamber.
Mm-hmm. I think the IMF recently in April wrote a piece about negative interest rate policy and cashless society. And in their research, they show that you need 5 to 6 full points of interest rate movement to combat a recession. The central banks do. Only 3 countries were above that, and all 3 of them are experiencing currency crisis. I think they're already fighting currency issues. That included Turkey and 2 other nations.
How many interest rates? I'm sorry. How many interest rates did they say?
5 to 6%.
Yeah, that's exactly correct. My research is 5.25% to 6%. Yes, I think exactly.
So if we get into a recession and we're sitting at 2.2 or 2 or even lower than that, it seems to me that they probably have to go below the zero bound and do the negative interest rate policy. The IMF says, based on the experiment in Europe, you really need to go cashless in order to make large amounts of negative interest rate policy work. So do you anticipate when we go into the next recession, they're going to provide some alternatives to cash? Are they going to go to electronic banking as they go negative interest rate, or is there some other way that they could fight the recession?
Well, I've written about this for quite some time, so it's not new. I guess I'm ahead of the IMF's papers. Madame Lagarde, who's going to be the next ECB president, is supposed to be more dovish than Mario Draghi, if you can, God help us all. But so you just can't have a negative deposit rate for consumers. They don't have that now here in the especially not here in the United States. But if you make your negative depot rate for consumers, not just for your bank deposits at the central bank, but for consumers, then you're going to generate a run on the bank. I mean, eventually, maybe some consumers will park, if you have a negative 1% rate, they'll say, what the heck, I'm not going to have hundreds of thousands of dollars if you have that stashed under your couch in your home or under your mattress. So they're going to have to go to, I think they'll ban, like they try to a certain extent in India, ban physical currency. And if they do that, you go to some electronic kind of maybe blockchain based Fed coin or IMF coin, where you either can leave your money in the bank or you can spend it. It's your only 2 options. There's no hoarding of cash. And in that way, they can make your interest rate as negative as any interest rate they damn please. And there's zero you can do about it. Nothing you can do about it.
So what would you recommend to investors to do now? It seems as though the stock market's in a bubble. We know the bonds probably aren't really safe right now. I would argue that the corporate bonds are really bad as well. There's a lot of those in junk debt territory, with a lot more just sitting a level above that. So where should investors be putting their money right now? What's a safe?
So where have I manage? It's not a theory. I manage money for a living, and I have to do this every day. So I have I just printed out my 20-point model, which I run on a daily basis, and I apply that to my investment spectrum. What we've been doing for the past few months is we've been owning bonds, even though I hate them in the long run. We just had a nice discussion about the bond bubble. I wrote a book in 2013 about the coming bond market collapse. So I absolutely hate bonds. but I think they're going to absolutely implode in price someday. Yields will skyrocket. That day is not here yet. What will cause that to happen is either a recession or inflation. And I mean inflation that really starts to become such a salient issue that the central banks have to take notice of it. So, I mean, that's why it's important and imperative to have an accurate, viable model that I have created over the last few decades. And models always change and they're updated to, any good model isn't static. But this one will tell me when we have either on the doorstep of a recession or an outbreak of intractable inflation. Those two factors will kill the stock market and the economy precisely because they'll blow up that bubble we just talked about, the bond market. You think about what happens in a recession where you have all these zombie companies. Maybe I think close to 10% of all the companies on the planet are now zombie companies. They have to, zombie being defined as they have to raise new debt to pay off the interest on existing debt. They don't have the EBITDA to pay off their existing creditors' interest payments. So they get shut out. They close the doors. Mass layoffs occur. The stock market, which is now at 140% of GDP, which is just about double its historical average, that traders, and you get mass layoffs and you have this global deflationary depression, which I think is almost virtually guaranteed to occur once you get one of those two factors. Now, you have to say to yourself, we'll never have a reversion to the mean of interest rates to argue against that point. We'll never have inflation and we'll never have a recession. But as I said, a recession will blow up the junk bond market and inflation will blow up the junk bond market and the stock market. You could get, Robert, both at the same time. That is probably my base case scenario. Because if you keep on printing, you keep on creating money, you keep on pursuing this asinine 2% inflation target, you're going to get that at some point, in my opinion. And when you get that, then you're going to actually have this implosion of asset prices globally.
Yeah, I think a lot of the Austrian school economists, and we were talking about the Austrian school before the interview, argued that when you have a deflationary depression, hyperinflation of the currency is really the flip side of that coin, because they're going to have to print to try to stave off that depression. And that's where they have to bring out the proverbial helicopters of money in order to try to goose up the economy. And that's where the currencies, such as in Germany's case or Zimbabwe's case, have basically become fancy green pieces of paper.
Well, we're going to be. I think we're going to become more like Rome. The G7 will become more like Rome. You can't have a classic hyperinflationary banana republic blow up unless you're an isolated currency that's not really used in international trade. So you have a current, like you see, like you mentioned, Argentina, Zimbabwe, Weimar Germany. These weren't reserve currencies when they blew up, and they had that crisis was salient in their issues because they had to import a lot of goods and services with the currency that was losing its value. So the U.S. dollar, I don't think the U.S. dollar is going to lose its value vis-a-vis the yen or the yuan or the euro, in as much as it's all of the currencies are going to lose their value against precious metals, which is what's happening today. I mean, it's no longer a prediction; it's happening.
Yeah. We talked about that. I'd written several stories this year about what looked like going to be a good year for the precious metals, both gold and silver, for 2019. It looks like that call was correct. And I think a lot of it has to do with the fear. As I graph out the precious metals, gold seems to have a base around the cost of the major miners, so the Barrick and the Newmonts of the world, adding in an amount for flowing into the GLD fund, sort of a fear factor or a safe haven factor. And as the trade war has spiked up a little bit, and we've got very close to the 2 and 10-year yield curve inversion, it looks like people are moving a little bit more into the gold fund. You see the gold price going up. Well, do you think that gold, now that it's reached this new plateau around 1450, do you think it's going to stay there? Do you think it's got another plateau to go? And if so, what do you think could be the catalyst for that?
Well, the yield curve isn't, but the 210 isn't inverted. I think there's 13 beeps between the basis points, right, 2-year and the 10-year. But more importantly, is the overnight Fed funds rate is still way above the 10-year note. That's been inverted for over 3 months. And every time you've had an inversion for more than 3 months, every single time it has engendered a recession. So that's the most important. I mean, if I'm borrowing money at 2% and to buy a treasury that's 1.71%, That doesn't work, and that's how money in a debt-based monetary system. That's how money is created, through debt. So if banks aren't, the shadow banking system isn't borrowing on the overnight lending rate to buy, CLOs and mortgages that are barely above where the Fed funds rate is, then the money supply shrinks, and that's when you get your deflation. But you asked me about gold. What does gold love? Gold loves negative real interest rates, and that's exactly where interest rates are headed. I mean, your nominal rates are headed to zero if they're not there already. You have inflation targets. The illusion has been shattered. The omniscience and omnipotence of central banks has been obliterated. These people they're out now that they have this monthly meeting now. Every Fed meeting has a press conference, and press conferences you ask questions, and we used to be data dependent. Now we're not even data dependent any longer. You have to hear the Powell conference and listen to what this man says to understand that the Fed knows nothing more than what you know. They have access to pretty much every piece of data that you have access to, but their models that they use to assimilate the data and project a conclusion from the data are all flawed. I mean, they're still thinking about the Phillips curve for gosh sakes. So I believe that you asked me about gold. I think gold is headed to an all-time nominal high by the end of 2020. That's my prediction. But again, we're just making predictions. It's hard to make predictions because there's only one person who's omniscient, and that's not me. I can assure you that. But if you extrapolate where interest rates are headed, where they're headed nominally, where they're headed in a real sense, and then you place the position of the U.S. dollar against those falling real interest rates, and you come to the conclusion that gold has a very, very strong bid and should head back to $1,900 an ounce by the end of next year.
Okay. I know that we have limited time. We both have appointments after this, but I want to ask you one more question. It's in relation to outside of the U.S., the international trade. I believe China is, and Russia, the Middle East, and parts of Europe are now setting up along the Belt and Road Initiative. And I believe Italy and Germany have already signed contracts. Britain has expressed an interest in getting involved in the financial side, to be a financial center in that system, much like they are in Western finance. Do you see that changing the landscape overall for the petrodollar, the dollar as reserve currency? And if so, what time frame do you think that could occur?
Well, more to the case, what I think you're asking is, the dollar is losing its world reserve currency status. That is beyond the shadow of doubt. But I do believe that since China is hoarding gold and Russia is hoarding gold, Italy has a lot of gold, there could be a move towards a gold-backed cryptocurrency. Right now, China is running out of dollars. China has a tremendous dollar deficit. These countries need dollars to purchase energy. They need these dollars to fund current account deficits. So what I think is going to happen in the near future, and I think it's in the process of happening now, is that these countries no longer want to park their reserves in dollars, in treasuries, and in assets of America. And I don't want to get into a geopolitical discussion of if you like Trump or if you don't like Trump. All I will tell you this, that these countries need to diversify outside of dollars. And to do that, they would need to have something like a cryptocurrency backed by gold, which they can use to exchange resources. And I think that's going to happen. I think it's happening and will probably happen very soon.
Okay.
If the consummation of that will happen soon, sooner than you think.
But you're thinking the dollar is going to stick around at least for a while, at least another 5-10 years.
When you say stick around, I mean, the dollar is going to be around for a very, very long time. It's probably the, I like to say it's the, if you ever say it's the cleanest shirt and a dirty laundry, I like to say it's the amoeba with the highest IQ. So the dollar is strong relative to other currencies right now because we have that interest rate differential, and our economy right now looks pretty good compared to that of China and Japan and the Eurozone. That is all irrelevant when it comes to the need for China and Russia and some of these other Eastern European countries and Middle Eastern countries to move away from the petrodollar system. So they're going to look to seek to back a currency with gold, cryptocurrency with gold, and remove the need to hold reserves in US dollars.
Okay. So Michael, can you tell the viewers how to get a hold of you if they're interested in some of your portfolios?
Okay, so I have two offerings here. You can come to my website, which is pentoport.com, and sign up for my midweek reality check. I put a lot of time and effort going through the most salient issues and data points that you will not find in the financial media. I talk a little bit more about my portfolio construction on the midweek reality check. It's only $49.99 a year. It's a free trial for 5 weeks. Of course, if you have $100,000 around that to invest, you can come to my Pento Portfolio Strategies Inflation, Deflation, and Economic Cycle portfolio, and I'm sure we'll take very good care of you. We have a track record that lasts many, many years. That's verifiable by a third party, and I'm sure you'll be happy knowing that you're with someone who always models the economy and tries to place your assets appropriately based on the dynamics of growth and inflation, and will even protect you in stagflationary environments and if we have a deflationary economic collapse like we had in 2008, because that's a very real risk. And you're going to need to make sure you don't lose one half of your principal for the third time since 2000. That is imperative for those of us who are close to retirement.
Okay. Michael Pento, Pento Portfolio Strategies. Thank you very much for joining us on Gold Silver Pros.
Thank you, Robert.
This has been a Gold Silver Pros production. Please subscribe to us on YouTube and sign up for our newsletter on goldsilverpros.com.